market's still kind of trying to find their way here. In terms of sectors we're watching, energy seeing the biggest bump right now, up more than 4%. We're also seeing materials up there as well. But you get the sense, Brian, that things are kind of in a holding pattern, if you will, as investors look to Friday to see what comes out of Jackson Hole.
Yeah, well, I mean, I kind of emphatically responded to kind of how markets are going today, especially when you consider the bloodbath, if you will, that was the markets yesterday. But look, on a 5-day basis, it's been pretty rough out there for stocks when you consider S&P 500 down 4%. Now, obviously, in the scale of what's been going on in that market rally the last 2 months, that hasn't necessarily erased any sort of gains that you would have gotten over that period of time. But look, volatility, broadly speaking, has gotten a lot higher over the last few sessions. When you take a look, for example, at the VIX, which is currently about a 22 handle, I believe. But keep in mind that we were about 19 not long ago. So this is just markets getting a little bit jittery ahead of, obviously, the Federal Reserve's big meeting later on this week, where we're expected to hear from Fed Chair Jay Powell. Could deliver some more hawkish commentary. But look, you combine this with the info that we got this morning. Manufacturing PMI is coming in a bit soft. New home sales declining to the slowest pace since 2016. All these headlines broadly spell an economy that is indeed slowing down. If the Fed gets more hawkish, that's only going to accelerate.
Yeah, no question about that. And yet you could argue, if we're talking about where the U.S. is in comparison to the rest of the world, things aren't quite as bad. And we've been watching the European markets really closely this morning on the back of some data coming through. August PMI pointing to business activity contracting for a second straight month here. The largest contraction in 18 months. We saw the euro fall below parity, with the dollar hitting a 2-decade low. We're talking about all of this ahead of what some have said is really an impending crisis when you look through to the winter, the concerns about energy, how those higher costs are going to affect the broader economy across Europe. We got this news earlier this week about Russia's Gazprom saying that, look, we're going to do this unscheduled maintenance into Nord Stream 1, which is the key pipeline for natural gas coming in through Russia. So there's a lot of headwinds already that investors are looking ahead to. And yet this number today points to that slowdown already happening. And the concern here is how much more that's likely to accelerate.
Yeah, and you mentioned the Eurozone PMIs. It's important to obviously unpack that country by country, the story is going to be a little bit different. Germany actually came in a little bit stronger than expected. France, however, coming in weaker than expected. It really depends on kind of what specific country you're looking at. But broadly speaking, the concerns are very much there. You think inflation is a problem here in the United States? Well, take a look at what's going on in Europe, when even in the UK, for example, right? Not technically part of the Eurozone with Brexit, but they're experiencing 10% year over year inflation with the expectation that's going to go up perhaps even to 18% by sometime next year, as some calls. So, look, at the end of the day, this whole global story impacts our view of the United States situation as well. Let's say the Fed can wrangle things by the end of this year or by the beginning of next year and get inflation coming back down. What if there's a spillover effect that happens in Europe in 2023 that ends up exacerbating and reversing any of the improvement we get here stateside? A very much an open question.
Yeah, I mean, energy is certainly going to be key to this, at least if we're talking about Europe. But the other story we're watching, of course, is what's been playing out in China. Yesterday we got China slashing its mortgage lending rate for the second time this year. The property market certainly in focus, and the PBOC trying to limit this fallout from what some would argue is the liquidity crisis there.
Yeah, well, I mean, when it comes to China, we've been talking about this, and this is not a surprise to anyone. This is not the first cut that China has delivered. In fact, it's another surprise move. I think they actually cut rates last week. So these are, coming at a time where China is really trying to balance and make sure that they are not going to over leverage the system, which is kind of a tough situation because, if anything, lowering interest rates could have the impact of doing that. But with the economic slowdown, they're also trying to counteract any sort of malaise in demand among the very powerful Chinese consumer that is driving their economy now. This Chinese economy is not like the Deng Xiaoping Chinese economy, where the drive of all GDP is really coming from manufacturing. They need a strong Chinese consumer. But does that exacerbate the leverage issues that they're experiencing? Very much an open question.
Well, and if you look at recent numbers that we've gotten from the likes of Alibaba, even at JD.com, that consumer confidence, or at least the strength, is not where it used to be.